Hi guys, I didn't plan on starting to record these videos so soon, but I won't be in class for when you guys begin looking at balance sheets. I will be in Melbourne. I've had some things come up, so that's where I'll be. But I didn't want you guys to miss out, so I wanted to tell you guys today about the balance sheet. Now, we started looking in our first lesson, and we've worked with it a couple of times on the accounting equation, which is assets equals liabilities plus owner's equity. Because the balance sheet shows us the financial position of the business. It shows us the assets that are under control of the business, the liabilities, and we talked about our definition of liabilities. There are obligations that the business has, and also the owner's equity, which in a way is the business's obligation to the owner as well. So, as an example, let's look at this balance sheet. So, here we can see that we have cash at bank. So, we've got cash. We have an inventory of $50,000. So, that's our stock. And we have display equipment. So, these could be shelves, things like that. And that all adds up to $120,000. We have a bank loan of $20,000, and we have capital, which would be everything that the owner has put into the business, of $100,000. So you can see that it actually balances out because the cash that the business has, the inventory that we have, and the display equipment can only come from two sources. It can either be purchased by the bank loan that we got, or it can be given to the business through the owner. Okay? So that's how it's always going to balance. But that balance sheet didn't give us a lot of information. We can be more specific about it, and this leads us to classified balance sheets. Okay? And when we look at assets and liabilities, we classify them as current and non-current. Basically, what that means is that we're splitting things into short and long term. But I'll go into greater detail in that in a moment. The reason that we aim for this is that because it allows us to have more understandability in our reports. So a classified report shows more detail, and we can see which assets are going to be used up and which obligations or liabilities we're going to pay sooner. So we can prioritize them. It's useful information and it's understandable information. Okay. So when we're talking about a current asset, we're talking about resources that provide economic benefits within the next 12 months. So we could use cash. Technically, we could spend all the cash that a business has in one day. We could use it up. We could sell all of our inventory within a year. And we hope that we can claim all of our accounts receivable, who are customers who have been provided credit. All of those we hope will give up economic benefit within a year. Okay? We then have non-current, and our non-current is expected to help us generate revenue for more than 12 months. So this could be a vehicle, it could be a computer, shop fittings and equipment. All of these things will last for more than 12 months, so they are expected to help us continue to create revenue. Okay? Same thing when we're looking at current liabilities and non-current liabilities. We have current liabilities, or obligations that we expect to settle or pay off within the next 12 months. And then we have, so these are things, like overdrafts, loan repayments, and credit cards, all these sorts of things. Accounts payable. So the same way that we offer credit to some customers, some businesses will offer us credit. And in cases like that, we have an account payable. So all of these we would expect to settle within 12 months. We also have longer term debts. And these longer term debts are things like long term loans, and things like that. things that we expect to take longer than 12 months to pay off. So these could include car loans, mortgages, and the like. But the important thing that we need to know, and we'll look at an example of this, is that with a long-term loan, there is a portion of that obligation that needs to be paid off within the next 12 months. So when we have loans, we actually have a current and a non-current portion. So let's look at how we actually report these. So loans might be current liabilities if all of our repayments are within the next 12 months, but we do have longer term loans that need to be split. So let's think about a business that has a loan and it owes $80,000 and we're only paying back $1,000 a month. Okay, clearly that's not going to be paid off in 1 year, but we will be paying off $12,000 in the next 12 months. So we can actually split it into two portions. We have our current liability of $12,000 and we have our non-current liability of $68,000. By splitting it up, it means that we can always know what our really pressing obligations are, so knowing how much cash we have to have on hand to pay our debts, and we also know for sure we can also provide greater information. So what it shows is that if we add up our current and non-current liability, it shows that we have that $80,000 obligation, and it provides greater understandability. Okay. So if we can classify our assets, this is what that balance sheet that I showed you before, this is what it would look like. So here you can actually see that we've got cash at bank of $40,000 that we could use up within the next 12 months or use to provide revenue in the next 12 months. Same with our inventory. And that adds up to $90,000. We also have our display equipment that we would expect to have for more than 1 year. We'd really hope that our shelving lasts longer than that. And then we have our bank loan. So you can see our bank loan is actually split into two portions. And there's a note there saying bank loan is due for repayment over the next 2 years with equal repayments. So if it's a $20,000 loan, you're going to have $10,000 in 1 year, $10,000 in the next, which means that $10,000 of it is current and the other $10,000 is non-current. As for the owner's equity, we don't classify that because the owner is owed that obligation by the business. But because of the going concern principle, we expect the business to never wind up or finish. So therefore, we never really call it a pressing matter for the owner to withdraw 100% of their capital from the business. That's expected to just stay for the life of the business. Okay? So, what this kind of shows, because this balance sheet is based on the accounting equation, it shows the twofold effect of transactions. And I'm going to show you this by looking at the following examples. So let's consider, first off, that the owner deposits $100,000 in cash to commence the business. So we know that this would be a twofold effect of increasing our assets by $100,000 and also increasing the owner's capital or owner's equity by $100,000. If we take out a loan for $50,000, we can see the twofold effect because we're suddenly getting $50,000 in cash, which is an asset to us, but our liabilities are increasing by $50,000. And if we pay off a portion of that bank loan, well, we're paying $2,000 in cash, so we're losing $2,000, but we're also losing $2,000 from that liability. Okay? So what I'll do now is I'll show you an example of how this is shown in the equation. So let's imagine for a second our accounting equation. So we have assets equals liabilities plus our owner's equity. Okay? Now, in any given situation, if we are given cash, that means our assets will go up. Okay? Now, if it's the owner giving cash, we then owe the owner. Same as in that situation where they said that $100,000 was contributed to the business. It could also be a situation where we have cash contributed by the bank, where our liabilities will then increase. Okay? But it could be a situation where, what if we spend $10,000 to buy a vehicle? We've given up $10,000 in cash, but at the same time, we get an asset. Okay? So in all of these situations, there's a balance. Okay? So you kind of need to think of this accounting equation as a scale. Okay? So on one side, pardon my terrible drawing. If you put something on one side, you either need to place the exact same amount on the other side, whether it's one thing or many smaller things, or if that's not the case, if you put something on one side, you need to also take another thing away. Okay? In order to make it balance. If you can do that, the accounting equation will always balance, and you'll always be making sure that the situation is correct. So, wrapping up. Make sure that you watch this video and you take down the summary, okay? Make sure that when I say meeting the learning objectives, make sure you've done all the questions that are involved. So that's the questions that are throughout the textbook, and also throughout the textbook chapter and at the end of that chapter, I will make sure that there is a photocopy of this chapter for anyone who doesn't have it. At the time of recording, so on Tuesday night, I have not done so, but I will make sure that Wednesday morning there is something there for you so you do have it, because I know that most of you won't have the book by now, so that's totally fine. Okay? And as I said, make sure that you've completed all the exercises at the end of the chapter. We'll be working on this next week as well, before study camp, and then at study camp we'll be playing a few games, wrapping things up, and getting a bit prepared for studying over the holidays, so we can jump straight into week 3 essentially of your year 12. I'm super excited for you guys to be undertaking this course, and I'm once again really sorry that I can't be there today. None of this was planned, and I'm so sorry for that. But if you do have any questions, please feel free to email me. You all have my email on all of the lesson plans and stuff like that. I will still be responding to emails while I'm away. So, yeah, I look forward to hearing from you and helping you out if you do have any problems. Thanks. See ya.